Hi and welcome back. We are learning the bonds and bond pricings, in which we are learning the behavior of interest. We have already understood the factor determining the bond pricing. Okay, that is, what are the factors that determine the demand for bonds? We have already understood, and now in this session, we are going to discuss what are the factors that determine the supply of bonds, and also eventually we are going to discuss the impact of interest rate during the recessions. Okay, so now we have already understood that any changes in the factors other than the price factor of the bond will shift the demand for bond curve. For example, the factor or the other factors that determining the demand for bonds are wealth, right? Expected rate of return or expected real return, and the risk of the bond, and also the liquidity of the bond. Okay, so so the riskiness of the bond actually will have negatively related to the demand for bond. Okay, and the other factors that are wealth and the expected return rate and liquidity all are actually positively influence the demand for bond, and therefore the changes in these variables will cause the shift of the demand curve to the right. Okay, now let us discuss the factor determining the supply curve. But now let's understand, why does the supply curve of the bond slope upward? Remember, we have drawn a supply of bond curve that slopes upward, but why? Okay, the answer is very simple here. As the price of bond increases, okay, or their yield decreases, the bond issuer will want to issue more bond because the yield or the interest rate they have to pay to bondholder has actually decreased. That means the borrowing cost of the bond issuer actually declines, right? Okay, means whenever the so when price increases, okay, borrowing cost of the bond will decrease, and therefore the issuer actually issue more bond. Okay, and therefore supply of bond is likely to increase. There is a positive relationship between the supply of bond and the price of bond. That is the reason the supply curve slopes upward. Okay, so let us now discuss what are the factors other than the price factors, okay, that influence the supply of bond. Several factors, okay, influence the supply of bond. Okay, one of such is like business expectation for the profitability of investment, or expected future profit, or we will say like, if the firm expect, okay, in the near future it is going to be more profit or more profitable, okay, or its investment will actually enable it to get more profit, then what will happen to supply of bond? Okay, so if firms are more optimistic about the future, that is, if the firm expect it can make more profitable investment, then firm will be willing to borrow more to finance their investment. Okay, and that is the reason it is expected that firm will go for more debt financing, and they will issue, or they will likely to issue more. Like another factor which is very important is the expected inflation. Okay, so remember that if you think there will be inflation in the future, you want to borrow more now. Okay, why? Because inflation reduces the real cost of debt. Okay, how inflation will reduce the real cost of debt? Imagine you have 1000 rupees debt and you earn 200 rupees per hour. Okay, so you earn per hour 200 rupees and you have actually a debt of 1000 rupees to pay off, right? So that means you have to work, okay, at least 5 hours to pay off the debt. Now imagine that there is an inflation and therefore your wage is likely to increase, okay, but the amount of your debt does not go up with inflation, right? So now your wage is, suppose, let's say 250 per hour, okay. So because of the inflation you are now expecting your wage to like 250 per hour and therefore you require only 4 hours to work, okay, to get 1000 rupees to pay off your debt cost. Therefore the real cost of the debt has declined with an increase in inflation, okay. So what we have understand here is that the real cost of the debt has declined with an increase in inflation, okay. So what does it mean? It means that, okay, so it means whenever like people expect more inflation, okay, then people want to borrow more. That essentially means that, okay, they will go for the debt financing and they will issue more bond. So higher expected inflation will lead the issuer to issue more bond, okay. Another one is government budget deficit, okay. What happened? Remember that not only farm will require money for its finance, but government also require money for its financing purpose, and therefore there are two routes for the government. One is tax, another one is to incur the debt. So government issues bond to finance its expenditure, okay. Therefore an increase in government budget deficit, okay, an increase in government budget deficit lead the government to issue more bonds. So the supply of bond in the market will increase. So higher the government deficit or the higher the budget deficit, higher is the supply of bond, okay. Another one is corporate tax. What happened when the government actually impose more? Remember, usually, okay, or theoretically, you can believe, you believe that a tax increase may reduce farm profitability of investment, okay. It is expected, right? A tax increase, okay, is likely to reduce farm profitability of investment and therefore farm will actually demotivate to issue bond. If that happens, then it will inversely influence, it will negatively influence the supply of bond. However, if the interest payment on the corporate tax, okay, or if the interest payment on the corporate bonds are tax deductible, we call it that tax shield, okay. If that happens, then the corporation may issue more bond to take this advantage, okay. And it happens also, okay, like in practice we expect farm to like go more on debt financing to take the advantage of this like tax shield or interest payment on corporate bonds are tax deductible, right? So if that happens, then we will expect the corporate tax may increase the supply of bond. So both can happen in case of tax, okay. So what you have understood here, all these variables actually will like shift the supply of bond curve either to right or to left, okay. So holding constant all other factors, okay, including the price, expected profitability of investment opportunity will shift the curve to or shift the supply curve to right. Okay, and expected inflation rate is also, our changes in expected inflation rate will actually shift the supply curve to right. Same, like applied to, like corporate, sorry, the government deficit or the government budget deficit also. But in case of business tax or the corporate tax, okay, tax reduce the profitability of investment, and therefore an increase in business tax reduce the supply of bond. The supply curve will shift to left. Okay. However, if the interest payments in corporate on corporate bonds are tax deductible, then supply curve shift to right. Okay. So now you have understood that both, like, you know, uh, factors that are determining the demand for bonds and the factors that are determining the supply of bond. And now in equilibrium, therefore supply is supposed to be equal to demand for bond. Okay. Now, so before entering into more on the behavior of interest rate, let us also, okay, this is my favorite question, although, right, why does one deserve interest payment? We must understand the importance of interest rate. I believe you have already, like, learned this, okay, from the starting itself. But again, now let us for the time, remember whatever we have learned here. Why does one deserve the interest payment? Okay, like most of the time, two factor or two reasons actually can answer us the why our saving deserve the interest payment. One is the presence of inflation. Okay, one is the presence of inflation. So your 1 rupee can buy more today in terms of real goods than in the future, and therefore you demand an interest, okay, or you demand an interest rate to compensate for the loss of your purchasing power, right? Second one is, like, most of the time people prefer like present consumption to future consumption, right? So our present consumption is more important than future consumption. Okay, and therefore to get you to postpone the consumption for the future, the borrower must offer, okay, some compensation in the form of an interest rate, and this happens even without the inflation. Okay, or in the absence of inflation also this can be possible, right? So because, like, you are very much interested in current consumption, the moment you are agreed to lend money, okay, that means that you are postponing your present consumption to some time in the future, and therefore the borrower need to compensate you, okay, for this purpose, right, or in the form of an interest rate. Okay, of course, like, how strong your preference is actually matter here. Okay, so how much would you need to be offered, okay, depends on how strong your preference, okay, for current consumption is. Higher this preference, higher will be the interest rate. Okay, so we will say that much, the stronger the preference, okay, higher will be the interest rate, because it is so important, but you still, are ready to postpone your current consumption to future, and therefore you may require a higher interest rate in this case, right? So there are at least two reasons why our savings deserve the interest payment. Okay. Okay. So let us also understand what is nominal and what is real interest rate. Of course, again, like, like probably during the time of like annuity and like other discussion, you probably have already discussed it, but again just recall it whatever we have discussed. So nominal interest rate is basically the interest rate in terms of the monetary value. Okay. On the other hand, the real interest rate, the interest rate in terms of the baskets of goods, or in terms of how much goods and services you are going to get, okay, or purchase, okay, with the same bill, right? So interest rate is adjusted by subtracting expected change in the price level so that it more accurately reflects the true cost of borrowing. Okay. So the real interest rate reflects the rate of time, okay, or rate of time preference for current goods over the future goods, right? So it reflects the change in the purchasing power. So the real interest rate actually will reflect the change in the purchasing power, and therefore, okay, people most of the time, okay, worried about the real interest rate and not the nominal interest rate. Okay, right. So let us understand a very, like famous concept in economics as well as in this concept here, which is known as Fisher effect. Okay, so what is the Fisher effect and what is the Fisher equation? The Fisher effect basically tells us that the expected inflation and the nominal interest rate will tend to move together over time. Okay, so as the expected inflation increases, the nominal interest rate also will increase, okay, over the time, right? So we can just simply rewrite this equation as, like nominal interest rate representing small I, okay, which is equal to the real interest rate R. Okay, remember that this R here actually we are talking about the real interest rate, okay, the different from the coupon rate what we have used here, but concentrate on this class, like actually, and then we will, like understand this R at the real interest rate and this I is the nominal interest rate, okay, plus the expected inflation, whatever inflation you are expecting. So what is inflation, by the way? The changes in the price level or the aggregate price level is actually known as inflation, right, which can be measured by the, like wholesale price index or consumer price index or GDP deflator. Okay, and the inflation can be measured as simply the change or the growth, the WPI or the CPI or GDP deflator. So this equation can also be written in terms of real interest rate. So you will write in terms of real interest rate as real interest rate is equal to nominal interest rate minus expected inflation. So what does this equation mean? This is the very famous equations and very much applicable also. Okay, an increase in the expected like inflation rate lower the expected real interest rate. Okay, so and whenever inflation or expected inflation increases, it will actually decrease the real interest rate. Okay, so no, so this equation actually have, like meaningful, or in fact it makes sense. So just take one example that, okay, suppose the nominal interest rate is 5% and expected inflation is, let's say, 3%, and therefore the real interest rate is equal to 2%, right? So if you make a loan, you can earn 2% interest rate in real term. That is, the interest you earned in terms of real goods and service is the, like of 2%. Okay, now suppose that the nominal interest rate rise to 8%. Okay, initially it was 5%, but now it was, like now it is rise to 8%, and also the inflation, okay, or the expected inflation also increased to now 10% over the course of a year. So now what is the real interest rate? The real interest rate is actually minus 2%, right? So even though the nominal interest rate is actually increased from 5% to 8%, okay, our real interest rate is actually opposite, right? This is because in due course inflation also increased from 3% to 10%, and therefore understanding the inflation is very important. Okay, it actually have a crucial role in like analyzing the bond investment or investment management. Okay, so in this case, therefore, you are 2% worse off in real term. Okay, so we cannot simply say that like an increase in nominal interest rate is actually like feel a person better off. No, right? It completely depends upon what is the inflation rate. Okay, again. Okay, so if you are a lender in our case here, okay, what you would do? Okay, just think yourself that if you are a lender, what would you do, right? So clearly you would be less eager to make a loan, right? You don't want to make a loan if you are a lender. Okay, but if you are a borrower, then definitely you have already understood. Okay, if you are a borrower, then probably okay you would like to you know uh, get more loan, okay, or you like to ask for more loan, so you are better off, right? Okay, so just remember that when the real interest rate is low, okay, when the real interest rate is low, there are greater incentives to borrow and fewer incentives to lend. Okay, okay, so another important concept is, in fact, in finance, basically is known as return. So, what do you understand by return? Okay, or how to compute return, or what type of return actually we are talking about? Is it the same thing that we are, like same thing that interest rate what we have learned? Okay, is it the same as interest rate? The answer is not necessarily. Right? The answer is not necessarily. Okay, the interest rate sometime can be act as return. Okay, but sometimes the return is much more higher. Okay, or lower than the stated interest rate. So interest rate is not necessarily the return. So what is return? Many people think that the interest rate on a bond tells them all they need to know about how well off they are as a result of owning it. Okay, so if the investor think he is better off when he owns a long-term bond yielding a 10% interest rate and the interest rate rise to 20%, he will have a rude awakening, right? Okay, how? If he has to sell the bond, this he has to suffer a huge loss. Okay, right? Therefore, it is important that how well a person does by holding a bond or any other security over a particular time period is accurately measured by the return, okay, or the rate of return. Okay, right? So the rate of return in general can be computed as okay RT, which like basically we like major like represent this as the return on the investment, okay, or RT is equal to C plus P is the price, okay, PT plus 1 minus PT divided by PT, okay, where C is the coupon payment and P is the price, T plus 1 is the tomorrow's price and T is the today's price. So we can simply have it like C upon PT plus Pt plus 1 minus Pt divided by Pt. Okay, or simply we can take this component and this component. Okay, and therefore we can write like IC plus G. IC is the yield, okay, or the current yield plus the capital gain. Okay, sometime, okay, if we are using this return for stock and if this C is actually D, then this we can like call this as dividend yield. Now we could simply say like coupon yield or current yield. Okay, we can simply say current yield plus capital gain or capital loss. Okay, like G is representing here the capital gain, right? So a 1000 rupees face value bond with a coupon rate of 10% is bought for 1000 rupees and held it for 1 year and then sold it for like let's say 1200. Then what is the rate of return you are going to get? Okay, the rate of return using this formula I will get is actually like 30%. Okay, so now what you have to get it, like the payment to the owner is the early coupon payment, that is like 100 rupees, and the change in its value, that is 200. So 100 plus 200 you know divided by the purchasing price, initial purchasing price is in fact give you a 30% rate of return. Okay, so this is the like Pt plus 1 is Pt plus 1 here is our 1200 and Pt is equal to, you will take like this. Okay, then the return can be computed as what? We will compute as like this is 100, okay, plus this is 200, so it will be 300 divided by 1000, right? So you will have here like 30% return. Okay, so let us now understand the changes in interest rate due to a change in expected inflation and the Fisher effect, how it is important. Okay, so the Fisher effect says that, okay, I is equal to R plus expected inflation, and therefore, okay, we understood it very clearly here that the expected inflation will influence the interest rate. So for a given interest rate, okay, and therefore for a given bond price, when expected inflation increases, the real cost of borrowing falls. Okay, what we have already understood. Hence, the quantity of bond supplied increased at any given bond prices. So, an increase in expected inflation caused the supply of bond to increase and the supply curve to shift to right. Okay, a decrease in expected inflation caused the supply of bond to decrease and the supply curve to shift to left, what we have already seen. Okay, now look at more carefully here that when the expected inflation rise, okay, when the expected inflation rise, the supply curve shifts from the initial. So this is the blue curve, here is the initial, like curve, this one. Okay, so this one is this initial supply curve and this one is the initial demand curve, that is BD1 is our initial demand curve. Okay, and BS1 is the initial supply curve, and therefore point 1 here, okay, like point 1 here will actually give us the equilibrium price P1 and the equilibrium quantity. Okay, now so whenever expected inflation increases, the supply curve shifts from shifts from BS1 to BS2, that is towards the right, okay, and the demand curve shifts from BD1 to BD2, that is the left. So the demand curve shifts left and the supply curve shifts to right. So the equilibrium moves from point 1 to now point 2, causing the equilibrium bond price to fall from P1 to P2, okay, and therefore the equilibrium interest rate rise. So whenever the equilibrium price decrease, because we have already understood that there is an inverse relationship between price of the bond and interest rate. Whenever we understand P is decreasing, that means interest rate I is increasing, and therefore we have like understand that whenever inflation increase, it will lead the I to increase. Okay, this is understood very well from the Fisher, okay, or we will call like the Fisher equation, okay, the Fisher equation clearly give us the answer. Okay, let us also understand the change in the interest rate due to business cycle expansion. How does business cycle expansion actually influence the interest rate? What you have understood from the, remember, I am actually trying to explain you in the economics way of actual like looking at the interest rate. Okay, so in a business cycle expansion, so what do you understand by business cycle? Business cycle is basically the periodic fluctuation of economic activity. Okay, so periodic ups and downs of the economic activity is basically known as business cycle. Okay, so we have four phases in business cycle, and in the business cycle expansion is actually basically referring to the boom period, okay, where everything is good, right? So total production increase, high national income and consumer confidence is also high, but inflation is also high at this period of time. So in a business cycle expansion, okay, when total production is very high, which will lead the national income or the GDP to increase, or like very high, okay. So in this situation or this environment, firms willing to borrow more, okay, because they are likely to have a many profitable business or investment opportunities for which they need money, okay, and therefore they may go for the debt financing. Hence, at a given bond price, the supply of bond will increase, okay, and this means that during a business cycle expansion, supply curve for bonds shifts to right, okay. So during the business cycle expansion, therefore supply curve for bond shifts to right, okay. What happened to the demand side then? As the economy expands, okay, wealth is likely to increase and the demand for bonds will also increase. The demand curve will also shift to right. So in a business cycle expansion, both demand curve for bond as well as the supply curve for bond shifts to right. Understood? Good. So now look at this diagram here that explains the changes in the interest rate due to business cycle expansion. Again, so this is our original demand and supply curve for the bond, okay, and the new curve, okay, this orange one is actually the new curve, okay. So when a business cycle expansion, okay, so in a business cycle expansion, when income and wealth are actually rising, the demand curve shifts rightward, okay, what we have already See, the demand curve shifts rightward, okay, from here to here, and also the supply curve also shift to right, from BS1 to BS2. Okay, but it depends on the changes in price. Okay, here. So the equilibrium now. This is the initial equilibrium, and now this is the like new equilibrium, and therefore there is a change in price from P1 to P2. Okay, this change is depend upon, okay, like which curve shifts, okay, what, right? So if supply shifts more than the demand, okay, if the supply curve of the bond shifts, okay, more than the demand curve, then the price P decrease, okay, the price will decrease, and therefore the equilibrium interest rate is likely to increase, okay, which we have shown it in the diagram here, right? So if the demand curve, okay, if the demand curve shifts more than the supply curve shifts, then the P is actually increase, right? So we will see it here, like if the demand curve is, like, so if the demand curve is like here shifting towards right, so it is, sorry, the demand curve is shifting towards right, okay, right? So initially, let's say it is shifting, right, and the supply curve is also shifting to right, but we will now this one is like right. So therefore we will have here like this is the curve, okay. So the corresponding price will be here, this is P3, and therefore price is actually increased, okay. So price is increased in the sense that in the interest rate will fall, okay. So in either case, the quantity of bond sold is actually increased. So this is the initial quantity. So anything here, okay, whether it is from here or it is from here, in any cases, okay, any of the cases, the quantity of bond sold is actually increased from here. Like this is, we will simply say like Q1 to Q2 to like Q3, it is increased, okay. Okay, so now you may be curious to like know that why do interest rate falls during a recession, okay. Let us understand this. What will happen in the recession or when the economy enter into recession, okay? The consumer confidence actually will decline, the business confidence will decline, right? Okay, so at the beginning of an economic recession, household and firm expect that level of production and the employment will be lower than usual for some period of time, right? So household will experience a declining in wealth, and firm will also become more pessimistic about the future profitability of their investment projects, okay. So the declining household wealth will lead to, or the like it will cause the demand curve for the bond to shift to the left, right? That's what we have already understood, okay. So firms declining expectation of the profitability of investment in physical capital cause them to issue like very less bond, okay, which shifts the supply curve for the bond to the left, okay. So the equilibrium bond price rise as long as the supply curve for bond shifts more than the demand curve, okay, and therefore the equilibrium interest rate will decline, okay. Let us now understand this using the diagram, okay. In this, Okay, in this you can clearly understand here that why do interest rate actually fall during the recession. Remember what will happen. So this is one our initial demand curve, like demand curve and the supply curve, that is BD1. Okay, is the demand for bond and BS1 is the supply for bond, and initially we are here. Okay, the price is P1, right? So an economic downturn reduce the household wealth and decrease the demand for bond at any bond price. Okay. So the bond demand curve therefore shifts to left from D1 to D2, right? So the recession causes the demand curve to shift to left, okay, and also the fall in the expected profit, okay, or expected profit during the recession, okay. So lenders, it will actually like reduce the lender's supply of bond at any bond price, okay, and therefore the bond price also will shift to left. So both the demand curve shifting to left and also the supply curve is shifting to left in the case of recession. Okay, just the opposite in the case of like business expansion. Okay, so here as long as the supply of bond curve is large and the shifting of the supply of bond curve is higher than the shifting of the demand curve, okay, the price is actually in, right. So in the new equilibrium therefore, which is a T, like a 2 here, the bond price rise from P1 to P2. Okay, here in this case, right. So this is our, sorry, this is our P2, and here corresponding to this equilibrium point here. So P1, okay, is here and P2 is here, and there is a changes in price which is increasing, that implies that interest rate is actually decreasing. So what we have understood here is like, so in the economic expansion, okay, or the business expansion, right, both the demand for bond curve and the supply of bond curve will shift to right, but in the economic recession both the demand for bond and the supply of bond will shift to left. This will in fact cause the price to increase as long as the supply of bond is, or the shift in supply of bond is higher than the shift in quantity, or sorry, shift in the demand for bond, and therefore this implies that interest rate will declining during the, okay. So now that I believe you have understood the relationship between interest rate and inflation, and how interest rate behave in a typical situation when in case of business expansion and in case of economic recession. Okay, the other way of thinking the relationship between interest rate and inflation is that whenever inflation is very high, or whenever inflation is high, okay, now the central bank actually want to control this inflation, because one of the objective of central bank is to control for inflation, that is price stability. Okay, so when the central bank or when the government see that inflation is really high, it will actually control the inflation by increasing the interest rate. So usually they will set a like higher rate of interest. So both the Fisher effects as well as this activity of central bank will enable us to understand that whenever inflation is high, okay, the interest rate also is going to high. So an increase in inflation will lead to increase in interest rate, which is actually major concern about the or major concern for the bond investors. Okay. So, in the next session, we are going to discuss the yield curve and the concepts related to the yield curve, and therefore we will also discuss some of the economic theory that explain such yield curves. Okay. For now, we will stop here.